Fed, we know, do want to front-load the rate hike cycle, but is 100 basis points next week really warranted, even after CPI, or would that be overkill?
First of all, I think it would be a little bit of overkill. But even if it weren't, in the era of the Fed that we're in, this is a Fed that doesn't really want to shock markets, and they've already sort of thrown out trial balloons that it's going to be 75. I don't know that one core CPI number changes that necessarily. So I think we are going to get 75. I think the bigger question, Sri, and thank you for having me, by the way, is whether this changes the reaction function of the Fed in some of the next meetings. Meaning, we were kind of thinking maybe you get 75, then 50, and 25 to finish the year. Is that now 75, 75, 50? And you can kind of see some of the gyrations in the bond market that Rick Santelli was referring to earlier on this program as sort of manifestations of the concerns about what may happen later in the year in terms of Fed action.
Do you feel that the CPI was a tipping point whereby the market feels now that inflation expectations are going to be entrenched for the foreseeable future? There's a lot of wood to chop in terms of the tightening cycle. And does that mean that the trend is lower in the markets? And does the S&P retest June lows at around 3,700?
Sure. So lots to parse there. I think, first of all, was it a tipping point? I don't know if I want to say any one data point is necessarily a tipping point. When you look at the headline number, for instance, 8.3 is a huge number. We've actually been averaging over 8%, believe it or not, headline inflation basically since the pandemic began. And that's an astounding number, but it's right in line with what's been happening for a while now. So I do think the market is getting its head around the fact that inflation's here to stay. It's not transitory, as the Fed told us last year. And I think that is going to place a lid on stock market valuations, particularly the ones most sensitive, the longest duration assets that are most sensitive to long-term growth expectations. I think it's going to place a valuation lid for the foreseeable future on the stock market. Now, in terms of earnings, the earnings piece of this, I think, is really important because what we haven't seen is a whole lot of major deterioration in the forward earnings view of the market. And while I think that is a risk going forward, my team and I went back and looked at corporate earnings performance in the 1970s and the early 80s and the 71 recession, the 80 recession, the 81 recession.
Yes.
And some people might be surprised to find that earnings didn't really turn down that much. So we may have gotten a lot of the multiple contraction we're going to get. And if earnings can hold up, the market may find a little bit of a bid here. 3750 is definitely in play, though, no doubt about it. If we break 3900, I think that technical level is really going to be, I think it's going to be a crucial break.